Hey, gang, wanted to get this video out about the housing forecast, rate and housing forecast for 2023. Got some of these great slides from the MBS Highway, Habib group that we use a lot for forecasting in the residential space. These guys are generally dead on in their predictions and great friends of ours. So I'm just going to kind of shoot through these and get it out. There's a lot of questions on what's going on and what to expect next year. So if we can flip through here, some slides. All right. So as you know, inflation, consumer inflation is a big driver of mortgage interest rates. You can look at the red line as the core consumer price index, which strips out some of the non-essential items in the inflation rate. And obviously, there's different measures of inflation, but this is the one that the Fed really likes to use. And you can see here that over time, as the interest rates, as inflation was flat here from 2018 all the way through the COVID crisis of early 2020, where inflation, the CPI dropped low. You see mortgage interest rates kind of tracked with that up until the inflation started spiking in middle of the first quarter, start second quarter in July of 2020. Rates still held low because there was a quantitative easing period when the Fed was buying mortgage-backed securities en masse to keep those interest rates down. Once they stopped buying those in January of 2022, you'll see that that's when mortgage interest rates started going up in concert with inflation. And the good news is, as you can see here, towards the end of the year in 2022, they started to turn down. The inflation started to turn down, and the mortgage interest rates started turning down towards closer to 6%. And we look at the inflation, we believe that the inflation has really hit its peak and it is turning downward now, as we started to see in the last few reports. So again, taking this core consumer number, we are currently at 6% year-over-year number. It's a 12-month running total with the monthly averages. And so every new month that comes along, they drop off the previous month from 12 months back. So you can see now in November of 2022, which is the last reading for this year, we're not going to get the December reading until mid-January. It trails about a month and a half behind. The inflation numbers have been down due to a recessionary period that we're potentially in. A lot of people think we're in. Gas prices have been down. Prices at the pump have been moderating. So you can see here that we've been replacing in October and November of this year, we replaced 0.6% from October 21 with 0.3% in October of 22 and 0.5% in November of 21, 0.2% in November of 22, bringing that year-over-year average down. Those numbers are going to continue to come down for the next, let's say here from December, January, February, probably not as much in March of 2022 when we see in the 2023 reading, because March was a pretty low reading. But we get back into April, May, and June of next year, those are very large numbers that should be replaced with much lower numbers, bringing the overall core inflation rate down, which will help mortgage interest rates in the long run. One thing to take note of is one of the big 39% of that core CPI number are shelter costs. And you can see here in the purple line how much shelter costs have increased since COVID, since January 2021. Major spike, and they've already started turning down significantly. The current rate of increase in shelter is a 4.6% interest or 4.6% rate year-over-year increase in rents, which if you're an investor, that's a good thing. It's showing that you're still able to increase your rents even over the last couple of years. From an inflationary standpoint, you can see the numbers are trending down. And so since that's such a large component of the CPI, 39%, as those numbers trend down, that will also help the CPI number reduce. Now, there is a lag time there. You can see the number of 7.9% is the average number of those shelter costs that they factor into the core CPI. So the average has been going up, and it's going to continue to go up for a few more months before it sort of passes over the top. And probably a great pictorial illustration of this is a roller coaster where real shelter costs, you see as your roller coaster is peaking the top of the hill. If you're in the front of the roller coaster, you started to turn down the hill. So the numbers have started to come down where we are today, real shelter costs, but you don't feel it yet because you have the rear end of this roller coaster, which would be the average in the shelter number in the CPI, still has to hit the top of the hill and then crest and then come on over. So we think that's going to happen in January of this year. And again, start to feed into lower inflation numbers in the first quarter of next year. So when you look at the segments of the CPI, all of the major segments in the CPI index, except for shelter, have come down: food, gas, clothing, et cetera. So again, once these numbers for CPI start coming down significantly, the shelter number, then it's going to really bring that overall average down significantly, thereby impacting rates. Another thing that's impacting the rates this year specifically is you can see the relationship between the 30-year mortgage rate and the 10-year treasury bond. You see the spread. While it's not a direct correlation and it's not a day to day, you can see there's definitely a very strong relationship between the two. So generally speaking, the normal spread that we've seen historically for interest rates, mortgage interest rates, was about 175 to 200 basis points above the 10-year treasury yield. Put it another way, that's 1.75 to 2% on the interest rate. So if the 10-year treasury was yielding 3%, then your mortgage interest rate would be 4.75 to 5%. If the treasury yield was 5%, it would be 6.75 to 7%. So when COVID hit and really not COVID, the back end of COVID, when inflation really started to take off and interest rates, the 10-year treasury started to move up pretty quickly here last year, the spread, it got larger between the 10-year treasury and the 30-year. And the reason is because of the servicing part of the mortgage. Most people don't think about it, but when you take out a 30-year fixed mortgage with ABC company, ABC lender does generally hold that loan. They sell that to a servicer and you make the payments to the servicer. Well, there's a spread or difference between the interest rate, the 10-year treasury, and the amount of profit that that servicer can make on that loan over the long period of time. So in other words, to keep it simple, the longer that servicer expects to hold that 30-year mortgage, the lower that spread or that profitability needs to be for them to make the money they need to make to hit the target. So it has historically been between 1.75 and 2%, but in the last part of 2022, the run up in the last 6 months, that gap has widened to 3%. And the reason is because the smart money and the servicers and everyone in the sort of global people buying treasuries expect that interest rates are going to be coming down. And so servicers know that if someone buys a mortgage at 7%, they're not going to hold that mortgage at 7% for long if rates come down to 6% or come down to 5% or whatnot. And so they need to make money in a short period of time before they're paid off. And so those spreads have widened. And what you're going to see is, as their expectation here, and it's already started to happen here towards the tail end of 2022 in the last couple of months, as the inflation reports are coming out lower, as the expectation of recessionary environment continues to be more and more real, that spread or expectation from the servicer is narrowing back down. So that's another reason why we're going to see a reduction in the 30-year interest rate in a mortgage interest rate next year. A couple of things here too about recession, whether we're in one now or we expect that we're going to be in one. Recession definitely have a negative impact on interest rates. It brings those rates down typically. But you can see by the two charts here from Barry put up that from January of 2018 to January 2020, people's credit card and revolving debt was growing significantly. And then once COVID hit, there were a lot of stimulances that came out. People paid off a lot of debt, put money in the bank, and they were just kind of living off of that. And about July of 2021, stimulus checks stopped coming, and you can see people started living on credit card and building up revolving debt again to very large levels. So at the same time, they were spending the money. When they stopped getting free money from the government, they started spending money in their own savings because they're continuing to live the lifestyle they were living before. Now that will slow down. People will stop living on credit cards and revolving debt. And so that will put even less demand on the goods and services that we buy, which drive up the inflationary numbers. Another sort of indication of a recession coming is the inverted yield curve. Basically, take the 10-year treasury yield minus the 3-month treasury yield. Generally, you would think that the longer a treasury bond you buy, the higher their interest rate is going to be because you're tying up your money for a longer period of time. But when the yield curve inverts, basically the shorter term, so pays a higher interest rate than the longer, which is a signal of a recession. It's a very predictable signal of recession. You can look just historically back here to what do we have in the early 80s. When we come up here to, let's see, 87, you see where we dip below this zero line and it goes negative. That would be the inversion. So every time you see that inversion, just beyond that, the next year or two, you see a little gray area. And that gray area represents a recession. So it happened here around 2000. It happened here in 2006 and 7 recession. It happened here a little bit in 2020. And now we're way down in the negative right here at the end in 2022. So we certainly expected, based on the yield curve, recessionary period. So another thing that's really actually very interesting right now is housing demand. So housing formations are typically running about 1.7 million units. Those are new households that are created every single year when people go out and start families, that sort of thing, and they're growing. In the last 6 months of this year, as inflation drove mortgage interest rates up and rent costs went up, people tended to stay put where they were. And so household formations had dropped down to a low of 1.3 million, which is really just basically pent up demand. People are waiting for a better time to go buy that house to get back in the market or to go move out and start that house. And so when you take a look at the housing supply right now, what we've been seeing is housing starts completed, not started, but completed. It's about 1.5 million a month. And we're replacing about 1/10 of a million every single month. So total new supply on the market basically every year or every month is 1.4 million. And so we're running right now about 1.3 million household formation. So there's a little bit more supply than there are new household formations. But again, that 1.3 million is temporary. It got knocked down because the housing costs got so high. The interesting thing is that builders have learned their lesson from 06 to 09. So they're not throwing a bunch of new properties on the market. And so they're not overbuilding like they did back then. So they're not contributing to the problem. They're more or less sitting on the sidelines, waiting to see, what's going to happen here in the future. Now, when those household formations get back up to 1.7 and interest rates are coming back down in the spring, it's going to create an interesting dynamic in the housing supply issue. We're going to have a negative supply situation yet again. Okay. So you hear a lot of people talking out there about, hey, there's a housing crash. And, we all lived through 2008 to 2012, and that was actually a housing crash. And I think a lot of us know the reasons for that: overbuilding, people buying and homes they couldn't afford, they weren't qualified for. There were basically no qualification parameters. Pretty much if you could fall or married, you could get a loan. And obviously that created major issues. That has not happened. It has not happened since 2010. Everyone who's been in a home since then has been very qualified to get in that home, at least at the point when they qualified to get in that home. There's a ton of equity out there. In fact, you look here over the last, from 2012, once at sort of the end of that crash, right? Home prices are up 115% in the last 10 years. And in the last 2 years themselves, they're up 39%. So yes, home prices have moderated a little bit in the last couple of months, 2.5%, but that's still hardly anything compared to what we've seen in the last 2 years and what we've seen over the last 10 years, just a minor correction. And a lot of that, this is national number. So a lot of that is in the larger, more cyclical cities and markets like the Californias and the Phoenix, Arizonas, and some of the areas like that just go up and down kind of like this in a very kind of crazy pattern. In our area here in Virginia, much less of a cyclical market, much more of a stable, sort of a slow growing market, which is great when things turn down. Affordability, this is the big thing that comes up all the time. When you talk to people, they're like, well, yeah, okay, homes are a lot more expensive. So, and that is true. They are more expensive. So we can look at a little chart that Barry put together here. When you look at 2021, the average home price around $400,000, the average interest rate 3.5%, and according to Fannie Mae, the average payment around $1,796 a month. And according again to Fannie Mae, the average household income that purchased this home with these terms in 2021 had about a $9,000 a month income. So it's basically like a husband and wife each make $50,000 a year. So they're about $100,000 a year. And that is the typical home buyer for this home in 2021. So in 2022, this year, from 21 to 22, we've had 10% appreciation. So that same house this year would have cost $440,000. Your interest rate would have been on average around 6.25%. And the payment has gone up significantly, $913. What they don't talk about ever in the media is the income increase. So according to ADP, who they survey tens of thousands of employers nationally. They have data that goes back, for a long period of time. The average increase in pay for employees last year is 9, and it varied somewhere between the people that stayed on their jobs around 7.6% to the ones that switched jobs got an average 15.1% increase in pay. But it's weighted because obviously most people stayed, they stayed on their job. They didn't go take new jobs. So the average is about 9% if we use. So we use a 9% increase on the $9,000 household income. That's an $810 a month increase in their income. So that almost offsets the increase in mortgage payment. Now, of course, there are other expenses that have gone up too this past year with inflation. We have gas, food, and other services. So actually that's kind of the pitch, right? So the total cost when you factor those other things in is around $1,154 a month versus an $810 increase. So it is a bit of an affordability pinch. But if we look forward this year in 2023, we've incurred a lot of these expenses already. And if we look at the income increase and say, well, the average employee will see a 5% increase in 2023 versus a 9%, from the year before, that would give them an increase of $1,300 a month or $10,000 to $300 for next year. And that more than offsets the increase in the total cost of the inflationary effects of the mortgage increase. And couple that with the fact that we expect home interest rates to go down to the 5% range by middle of next year. The increase from 2021's 3.5% is more than outweighed here by the increase in pay. So affordability becomes less and less of an issue as time goes on and interest rates moderate. So with that, the forecast that Barry is expecting and that I agree with across the board for housing and the housing market is lower inflation. We're going to see a recession-like slowdown. It's going to be, in some areas be more recessionary than other areas. Incomes are going to increase to keep affordability in check. And as a good friend of mine, Jason Hartman, says, the other question on affordability is, compared to what? If you compare buying a home today, with different currencies and whatnot, it's actually still very reasonable. We generally just look at US dollars as a currency comparison because we're used to US dollars. But if you compare it to other things like, how many barrels of oil would it take to buy your house, or how many bars of gold would it take to buy a house today versus 5 or 10 years ago, you're going to see that it's much more affordable today than it was in 2000, even, interestingly enough. But the next thing on the housing is we're going to see a very tight inventory environment, and rents are still expensive and rising. So that's good if you're an investor. It's not so good if you're a renter. And so first time home buyers really need to make that leap to get into that home because they're going to lose the opportunity, right? As homes are going to continue to get more and more expensive, and builders aren't really building a lot of low and entry level homes. So the forecast for mortgage rates, a couple of things. Headwinds, we have global quantity of tightening. That people are tightening the money supplies across the globe. So that does have an impact on us. And sometimes there's a little unknown there. Foreign central banks aren't buying their equivalent of mortgage-backed securities anymore like they were, and there's just more debt to be financed. The other thing is, you've got unpredictability of, global wars or pandemics or things like that. So we just don't know about. Tailwinds that are helping us out though, going into 2023 is definitely lower inflation numbers, excess retail inventory. The cash shipping index just recently came out and their numbers show the cost of shipping globally is back down pre-COVID numbers. The numbers before in the last 2 years have been astro and they've come way down. And a lot of the large retailers like Amazon, Walmart, Target have all talked about excess inventories are building. And when you have excess inventory, the only way to get rid of it is to put things on sale, which then brings prices down, which again helps the inflationary numbers. Increase in mortgage servicing value. So the spread between the 10-year treasury and the mortgage-backed security or mortgage rate is going to come down. And again, recession likely, as we see, rates always decline during recession. So the 30-year fixed mortgage rates move near 5% during the first half of 2023. That's our forecast. And the 10-year treasury is going to be approaching 3% or maybe even lower by middle of this year. So we're very optimistic for 2023. We think it's going to be a great year for the real estate market. It's a great year for buyers. It's a great year for sellers. And it's a great year for professionals in the space. So be optimistic, look ahead. And I just like to wish everybody just a wonderful new year and look forward to working with you in the future. Have a wonderful day and God bless.